There are 5 banks that set the price of gold in London. Twice a day they agree on a single number, and that number moves markets on every continent. It is one of the oldest and most trusted positions in world finance. In the autumn of 1984, one of those 5 banks was sold to the Bank of England for £1. Not £1 million, not £1 a share. £1, a single coin, for an entire bank that helped fix the price of gold. It happened overnight, in secret, before the markets opened on a Monday morning, because the men who ran the country's central bank were terrified of what would happen if anyone found out how bad it really was. The bank was called Johnson Matthey Bankers, and it had done something that sounds impossible for a serious institution. It had quietly lent more money to a small handful of men than the entire bank was worth. When those loans went bad, they did not just wound the bank, they swallowed it. What follows is the story of how a gold house threw away 200 years of trust in about 4 years, why the Bank of England decided that letting it die was more dangerous than saving it, and how, in the end, not a single banker went to prison. Instead, they rewrote the law. This is Cooked Books. This is the bank that sold for £1. Start with the name, because the name is the whole problem. Johnson Matthey is one of the great old houses of British industry. Founded in the early 19th century, it built its reputation on precious metals, assaying gold, refining it, testing it, vouching for it. When a company's job is to certify that a bar of gold is exactly what it claims to be, its entire value is trust. That reputation earned Johnson Matthey a rare privilege. In the 1960s, it set up a banking arm, Johnson Matthey Bankers, and that bank took one of the 5 seats in the London gold fixing. 5 institutions sitting around a table, agreeing twice a day on the price of gold for the world. Johnson Matthey Bankers was one of them. For years, the bank did what a bullion bank does. It financed the metal trade. It was small, specialized, and respectable. It sat inside a 200-year-old name, under the umbrella of a parent company that made real things and had real customers. And here is the detail that matters for everything that comes next. Because it was a bullion bank with a spotless name, nobody watched it very closely. In the eyes of the Bank of England, it was an authorized bank, assumed to be competent, assumed to be safe, assumed not to need close supervision. That assumption was about to cost a fortune. In the early 1980s, the men running Johnson Matthey Bankers looked at their quiet little bullion business and decided they wanted more. Financing gold shipments is safe, and safe is slow. Real money, the kind that builds careers, was in lending. So the bank began pushing out of bullion and into ordinary commercial loans. Big loans to businessmen with big plans at interest rates that looked wonderful right up until the moment they did not get paid back. The growth was startling. Between 1980 and 1984, the bank's assets more than doubled. On paper, Johnson Matthey Bankers looked like a success story, a sleepy gold house transforming into a modern lender. Underneath, it was something else. The management was, in the words that Parliament would later use, grossly incompetent in the running of its own affairs. They were bullion men playing at commercial banking, and they were making a beginner's mistake. The most dangerous mistake in the entire business. They were putting too many of their eggs in too few baskets. The bank was lending enormous sums again and again to the same small group of borrowers. As long as those men kept paying, the numbers looked magnificent. They were about to stop paying. Every banking collapse has a moment where you see the actual names, and they are always smaller than you expect. Johnson Matthey Bankers did not fail because of some vast, faceless market. It failed because of a handful of men. There was Mahmud Sipra and his El Said group of companies. There was Rajendra Sethia, whose trading empire, Isal Commodities, would collapse into what was called, at the time, the biggest bankruptcy in the world. And there was Abdul Shamji of Gomba Holdings, a property man whose interests stretched to Puddle Dock and the Mermaid Theatre in London. To Abdul Shamji alone, the bank lent £21 million. To this whole cast of high-risk borrowers, it kept lending and lending and lending. And this is the sentence that defines the entire disaster. The size of the loans grew to exceed the level of the bank's own capital. Read that slowly. A bank is supposed to lend out other people's money carefully, keeping a cushion of its own capital in case things go wrong. Johnson Matthey Bankers had handed so much to so few that its loans to a single cluster of borrowers were larger than everything the bank itself was worth. There was no cushion. There was just exposure. If those men went down, the bank went down with them. So who were they, the men holding the bank's life in their hands? Rajendra Sethia is the one history remembers. His firm, Isal Commodities, traded sugar, grain, and shipping around the world. At its peak, his empire spanned dozens of companies and a turnover measured in the billions. Then, in the space of a few brutal months, it came apart. Frozen assets, angry creditors, and a collapse so large it was branded the biggest personal bankruptcy the world had ever seen. In 1985, Sethia was arrested. The gambler who lived by his wits had run out of both. Abdul Shamji went a different way, but no better. When the inquiry into the bank's collapse tried to work out what had happened to the money, Shamji lied about his own assets under oath. For that, for the lying, not for the borrowing, he was sent to prison for 15 months. And Mahmud Sipra, whose El Said group sat close to the center of it all, would spend the years that followed shadowed by fraud allegations of his own. Put the picture together. A 200-year-old gold house, one of the 5 banks that priced gold for the planet, had tied its survival to a group of men who were, one after another, heading for the bankruptcy court, the fraud court, and the prison cell. In August 1984, the loans went bad all at once, and the people who were supposed to be watching finally looked up. By late September 1984, the Bank of England understood the size of the hole, and it was staring at a nightmare. The problem was not really Johnson Matthey Bankers. The bank was small. On its own, letting it fail should have been survivable. The problem was that seat at the gold table. Johnson Matthey Bankers was one of 5 members of the London gold fixing, and the men at the central bank asked themselves a simple, frightening question. If one of the 5 gold banks is allowed to go bust, what does the world think about the other 4? The fear was contagion. If confidence cracked in the bullion market, it might not stop there. It could spread to the wider British banking system, bank by bank, in exactly the kind of panic that central banks exist to prevent. In 1984, the Bank of England decided it could not take that risk, so they moved the way these things always move. In private, at speed, over a single weekend. Officials from the Bank of England and the big clearing banks of the city were pulled in to build a rescue before Monday. They had until the markets opened to make Johnson Matthey Bankers look alive. On the 30th of September, going into the 1st of October, 1984, they finished the deal. The Bank of England took control of the bank, and the price it paid tells you everything about what the bank was really worth by then. The Bank of England bought Johnson Matthey Bankers for £1. That was the honest valuation. A bank that helped fix the price of gold, stripped of its losses and its bad debts and its whispers of fraud, was worth a single coin. Everything above that pound was whole. Then came the bill for filling the hole. The bank's own board estimated the losses at £248 million. Of that, 130 million was swallowed by the bank's own capital and reserves, wiped out completely. Another 50 million was thrown in by Johnson Matthey, the parent, the old precious metals company, trying to save its name. And to cover the rest, there was an indemnity, a promise to absorb future losses, split down the middle. £75 million from the private banks of the city and £75 million from the Bank of England itself. The Chancellor of the Exchequer at the time was Nigel Lawson, and when he stood up in the House of Commons to explain all this, he chose his words with great care. The Bank of England, he said, had paid only £1 from the banking department's own resources. Technically true, politically, an argument that would rage for years over whether public money had just been used to bail out reckless bankers. The people who truly paid were the shareholders of the parent company. They lost three-quarters of their money, some £250 million. The value of Johnson Matthey fell from £320 million before the rescue to about 90 million after. And here is the detail that should have been the alarm bell. The bank's auditors had signed off its accounts without qualification on the 18th of June, 1984. Clean books, nothing to see. Barely 3 months before the whole thing had to be bought for £1. Once the Bank of England owned the wreck, it started going through the drawers. What it found did not make the story better. There were, the Chancellor admitted to Parliament, serious and unexplained gaps in the records of Johnson Matthey bankers. The possibility of missing documents relating to substantial past transactions. A bank that priced gold could not fully explain where its money had gone. Johnson Matthey bankers asked the City of London police to open an inquiry. The borrowers, as we have seen, met their various fates. Shamji went to prison for lying about his assets. Sethia was arrested as the world's biggest bankrupt. Cipra had his fraud judgment. But now, ask the question this channel always asks. What happened to the bankers? The men who ran a gold house, abandoned prudence, and lent away more than the bank was worth to a handful of doomed borrowers. What happened to them? The answer is the quietest part of the whole affair. There was no great criminal trial of the management of Johnson Matthey bankers, no landmark fraud conviction of the men at the top. The people who went to prison were the borrowers who lied, not the bankers who lost control. The institution had been grossly incompetent. Its supervision had failed completely, and the punishment for all of it was not aimed at any single person. It was aimed at the rules, because the most important thing the Johnson Matthey affair produced was not a verdict, it was a law. Nigel Lawson and the Governor of the Bank of England, Robin Lee Pemberton, agreed to a full review of how banks in Britain were supervised. The official inquiry that followed named the causes without flinching. An over-rapid expansion of the loan book, a heavy concentration of exposures, and a lack of adequate control systems. In plain English, the bank had grown too fast, lent too much to too few, and watched none of it closely enough. Out of it came a rule so simple, it is almost embarrassing that it needed a disaster to write it down. No bank should ever lend to a single borrower, or to a closely related group of borrowers, more than 25% of its own capital base, except in the most exceptional circumstances. 1/4. That was the line Johnson Matthey bankers had blown through so completely that its loans grew larger than the entire bank. The review fed into the Banking Act of 1987, which tore up and redrew British banking supervision. It created a new Board of Banking Supervision to advise the Bank of England. 9 members, the Governor as Chairman, the Deputy Governor, and the Executive Director for Supervision, plus 6 independent voices from outside the bank, so that the men who missed Johnson Matthey bankers could never again mark their own homework in private. It was the 3rd time in under 8 years that Britain had rewritten its banking rules. This time, the wreck of a gold house was written into the text. There is one last thing you should know, and it is the reason this story sits a little apart from the others. For decades, when a British bank got into trouble, the Bank of England had a tool it called the lifeboat. It would quietly gather the big banks together, pool some money, and float the failing one back to safety before the public ever noticed. The rescue of Johnson Matthey bankers over that weekend in 1984 was the last time the lifeboat was ever launched. After this, the age of the quiet gentleman's rescue was over. The next time a British bank failed badly, the world would watch it happen in the open. Most of what was left of Johnson Matthey bankers was sold off. The parent company, Johnson Matthey, the real one, the one that refines precious metals, survived the wound, walked away from banking, and still trades today. The gold house kept its name. It just never kept a bank again. So here is the account, closed. A bank that helped price the world's gold, brought down not by markets or by war, but by a handful of loans to a handful of men, larger than the bank itself. A central bank so afraid of the truth that it paid £1 and swore the rest to secrecy over a weekend. Auditors who saw clean books 3 months before the end. And a set of bankers who lost everything they were trusted with and answered for it not in a courtroom, but in a rulebook. They cooked the books of a gold house. And the only thing that ever went to prison was the old idea that a great name could be trusted not to. This has been Cooked Books. The archive is open if you want another.